very correct. We had actually even looked at those bands, and we realized that the 10% indeed has not been taken up. But when you look at some of the reasons why people don't do that, especially when you look at the pension funds and the structures that are there, the trustees, for example, are very conservative. And I believe sometimes they are conservative because of the fiduciary duty that they hold. And so then how do you help in such a situation then to address such a challenge? Because before you encourage that kind of thing, the other aspect that we actually identified and we noted was the skill gap. There's actually a major skill gap especially within the pension sector. People need to be trained. They need to take risks, but sometimes people just don't do that, and they actually need a means of addressing that by educating enhancing skills of people. So your observation is very correct. I think we had a discussion of that kind sometimes. The regulations alone, of course, will not sort out businesses. In fact, the discussions have been, if business can run ahead of regulations, better. But before you come into as a regulator, for example, CMA has dual roles of developing a market and regulating it. So sometimes you wonder which one should come first. But then again, I think encouragement should be, people should run ahead of regulation and then come up with innovative ways of dealing with things. Otherwise, if you have regulation first, people will not actually be innovative, and so they'll be lagging behind in a big way.
Of course, a lot has been done with regard to coming up with benchmark bonds. The longest dated one, as you may be aware, was the 30-year. So we believe that should have been sufficient to be able to come up with a stable yield curve. But there are issues to do with macroeconomic, as mentioned earlier, there are issues of inflation that have come up lately. So it might not really be working the way we would have expected it to, but we believe as we continue to come up with this, the longer dated, we should be able to sort out that problem with regard to the yield curve. So on the issue of costs, there are already measures that we have taken specifically as the Capital Markets Authority to bring down costs. You may be also aware that we came out with specific costs, which I think, if I'm not wrong, comes to a maximum of just 0.035%. That's in terms of commission and fees paid by stockbrokers, paid by to the ICF, those that will go to the Capital Markets Authority. In total, it's coming to 0.035%, which I think within global standards, that is a fairly reasonable cost.
But what is it that we mean when we talk about the risk in Africa and perception of risk in Africa? And one of the things I think we've noted is what is seen as risk is very different between our local investors versus international investors. And therefore, how we tackle perceived risks will necessarily be very different in attracting those different potential investor bases. Especially when you look at the situation across the emerging markets and the very significant hit that emerging markets took on the whole from the crisis. It wasn't about any toxic instruments being actually traded in the emerging markets. It was about a second phase flight of capital as all the foreign investors in our markets were trying to shore up balance sheets elsewhere. And just the general sentiment of moving based on perceived risk rather than actual real market fundamentals and dynamics. Yeah. So I think we need to think very critically as we talk of risk and attracting investment. It's who is it we're attracting, for what purpose, and what kind of investment timeline are we targeting, so that we make sure that our markets do continue to grow and that they are quite sustainable.